Howdy, y'all. Welcome to Liberty Call. It is Tuesday, August 16th, 2022. I apologize for being a little bit late. I had had a court date for a speeding ticket, and evidently the magistrate, or whatever the hell they call those jackwads here in Douglas County, Colorado, says there was nothing he could do. It wasn't an emergency. So, yeah, had to wind up paying a ticket and getting points. It's ridiculous. But, hey, Officer Shithead, I hope you feel good about yourself. So, anyways, all right. Pretty decent day in the markets, other than technology. Looks like it couldn't get out of the red most of the day, but the Dow and the S&P 500 were decently in the green. Was a little disjointed, at least this morning. The Dow went into the green, and everything else was kind of lagging behind. And but hey, I guess a lot of traders seem to think things are hunky-dory right now. From my vantage point, I don't see it. But anyways, all right. Well, let's go ahead and jump into today's see how the indexes did today. The Dow Jones finished the day up 239 points, or 0.71% up at 34,152. The S&P 500 was up 0.19% at 4305. NASDAQ down 0.19% at 13,102. Small caps were basically flat. The VIX was down today 1.3%. It's currently sitting at 1969. Let's move over to the other indices here in the Americas. Canada up 0.44, Brazil up 0.43, Mexico up 0.34. Jumping across the Atlantic, Germany up 0.68, UK up 0.36, France up 0.34, the Euro stocks up 0.41, Netherlands was down 0.11%. Let's see, the Spain up 1.01%, Italy up 0.12%, Switzerland down 0.37%, and Portugal up 0.66%. Heading further east, in Russia, the MOEX was up 2% and the RTSI up 2.62%. Headed over to Asia, Japan was flat at down 0.01%, so basically no change. The Australia was up 0.58%, New Zealand up 0.44%. Headed over the Chinese markets, the Shanghai was basically flat, finished up 0.05%. Same with the SE component was up 0.08%. The China A50 was slightly down at down 0.11%. The DJ Shanghai up, or basically flat at up 0.05%. And the Hang Seng was down 1.05%. And the Taiwan weighted basically flat at up 0.02%. So, like I said, not a terrible day. Most things were up, but, nothing too major across the board. There were a couple that were up 1%, but nothing dramatic. So, anyways, let's go ahead and read through today's market recap and see what it says here. Dow rides rally and retailers to close above 3,400 or 34,000. The Dow closed above 34,000 Tuesday for the first time since May, led by a jump in retailers as better than expected results from Walmart and Home Depot pointed to strength in the consumer. Walmart reported second quarter results that beat recently lowered estimates and forecast earnings to fall less than expected following the retailer's recent profit warning. Its shares jumped more than 5%. The retailer said it now expected adjusted earnings per share to decline 9% to 11%, revised from previous outlook of 11 to 13%. Home Depot also shared quarterly results that topped Wall Street estimates, and the home improvement retailer maintained full-year guidance amid, quote, continued strength in demand for home improvement projects, end quote. Its shares also climbed 4%. The duo of better-than-expected results triggered a wave of greens in other retailers, also with Bath Body Works, Target Corporation, and Best Buy in the ascendancy. Financials were also pushed higher by a rise in regional bank stocks as Treasury yields continued to steady on easing worries about steep U.S. recession. Regions Financial Corporation, SVB Financial, and Bank of America Corporation were up more than 1%, while Ally Financial, Inc. jumped more than 4% after Warren Buffett's Berkshire Hathaway revealed in a regulatory filing it had tripled its stake in the online bank during Q2. Tech cut some losses, but weaker in semiconductor stocks weighed as Citi's latest view on the sector continued to flag declines in notebook shipments and said weaker PC demand will continue to impact growth. Citi reiterated its neutral rating on Intel and AMD, with the latter trading slightly in the red. Energy was one of the few sectors in the red, pressured by an ongoing slide in oil prices as traders weigh the outcome of talks to revive the Iran nuclear deal that could lift sanctions on Tehran, paving a way for a fresh supply of crude. Big tech, meanwhile, traded mostly lower as Apple flirted with gains and losses while meta platforms fell nearly 1%. Growth sectors of the market, such as tech and consumer discretionary, are up nearly 30% since mid-June, fueling optimism that the broader market is in the process of a V-shaped rebound to wipe out its losses this year. Quote, as inflation data weakness and economic data softens, that will make the Fed's job easier in the second half of the year. We're going to get a lot of price to earnings expansion, making all-time highs is possible, end quote. Fundstad Global Advisors Tom Lee told CNBC on Monday. Others, however, suggest the market is likely to remain range-bound amid ongoing monetary policy and inflation uncertainty. Quote, I don't think we're in a V-shaped recovery. I think you're going to see the market around a trading range for a while until there's more clarity with inflation and Fed monetary policy, end quote. Robert Conzo, CEO of Wealth Alliance, told investing.com in an interview on Tuesday. Yeah, I probably agree more with Mr. Conzo's opinion of things as opposed to a V-shaped recovery. Because again, same as 2 years ago, we haven't flushed out all the problems that we were dealing with going into a downturn. All we've done is, put Band-Aids all over everything. 2 years ago, we flooded the economy with free money. Right now we're doing inflation reduction bills, which have nothing to do with inflation. It's actually going to cost anywhere from $400 billion to $700 billion, depending upon what you're looking at, and it just expands government. So we should be shrinking the size of the federal government to save on expenses and paying down the debt, but no one seems to care. All right, let's see here. Next up, housing. U.S. housing starts near 1.5-year low. Factory outputs rebound. U.S. home building fell to the lowest level in nearly 1.5 years in July, weighed down by higher mortgage rates and prices for construction materials, suggesting the housing market could contract further in the third quarter. The housing market's declining fortunes brought fears of a broader economic recession back into focus, but with other data on Tuesday showing industrial production rising to an all-time high last month, despite the high interest rate environment, the Federal Reserve is expected to stay on its aggressive monetary policy tightening path. Quote, reading the tea leaves on the economy hasn't been this difficult in years, end quote, said Stephen Rupke, chief economist at Forward Bonds in New York. Quote, industrial production has turned down in every economic recession in history, so the record high this month is not consistent with a downturn, end quote. Housing starts plunged 9.6% to a seasonally adjusted annual rate of 1.446 million units last month, the lowest level since February of 2021. Data for June was revised slightly higher to a rate of 1.599 million units from the previously reported 1.559 million units, so it was up, about 40,000. Economists polled by Reuters had forecast starts would decline to a rate of 1.540 million units. Single-family housing starts, which account for the biggest share of home building, dropped 10.1% to a rate of 916,000 units, the lowest level since June of 2020. Single-family home building decreased in the Midwest and the densely populated South, but rose in the West and the Northeast. Excuse me. Starts for housing projects with 5 units or more declined 10% to a rate of 514,000 units. Multifamily housing construction remains supported by strong demand for rental apartments, with rising borrowing costs pushing home ownership out of the reach of many Americans. Permits for future home building fell 1.3% to a rate of 1.674 million units. Single-family building permits dropped 4.3% to a rate of 928,000 units. Permits for multifamily housing projects increased 2.5% to a rate of 693,000 units. The Fed, which is struggling to bring inflation back to the U.S. Central Bank's 2% target, has hiked its policy rate by 225 basis points since March. Mortgage rates, which move in tandem with U.S. Treasury yields, have soared even higher. The 30-year fixed rate mortgage is hovering around an average of 5.22%, up from 3.22% at the start of the year, according to data from mortgage finance agency Freddie Mac. Residential fixed investment declined at its steepest pace in 2 years in the second quarter, contributing to the second straight quarterly drop in gross domestic product during that period. More pain is likely yet to come for the housing market. A survey on Monday showed the National Association of Home Builders Wells Fargo Housing Market Sentiment Index fell for an eighth straight month in August, dropping below the break-even level of 50 for the first time since May of 2020. Rising construction costs and mortgage rates were largely to blame for the drop. While housing is struggling, another sector that is sensitive to interest rates is forging ahead for now. In a separate report on Tuesday, the Fed said manufacturing output rebounded 0.7% in July after declining 0.4% in June. Economists had forecast factory production would rise 0.2%. Output increased 3.2% compared to July of 2021. Manufacturing, which accounts for 11.9% of the U.S. economy, remains supported by strong demand for goods, even as spending is gradually shifting back to services. But risks are rising, with retailers sitting on excess inventory, especially of apparel. A strong dollar as a result of tighter monetary policy could make U.S. exports more expensive. Production auto plants surged 6.6% last month. Excluding motor vehicles, manufacturing rose only 0.3%. Output of long-lasting manufactured consumer goods increased 3.5%, while that of non-durable goods fell 0.3%. Mining production increased 0.7%, continuing to be underpinned by oil and gas extraction. Output at utilities fell 0.8%. Rising in manufacturing and mining output helped lift overall industrial production index by 0.6% to a record high of 104.8. Industrial output was unchanged in June. The strong manufacturing production is a stark contrast with regional factory surveys that have shown sharp deterioration in business sentiment. Quote, recessions are normally a loss of faith, and it would appear that manufacturers' sentiment is frayed, end quote, said Ryan Sweet, a senior economist at Moody's Analytics in Westchester, Pennsylvania. Quote, however, it's important to watch what manufacturers do rather than say. For now, manufacturers are not acting as if the economy is in or headed towards recession, end quote. Though higher borrowing costs are chilling the housing market, and outright collapse is unlikely because of a critical shortage of single-family homes for sale, which is keeping prices elevated. Fewer homes being built because of financial constraints could pose a conundrum for the Fed, which is seeking to bring down house prices by slowing demand for houses. Quote, lower construction will limit supply of housing and potentially dampen the impact of higher rates on home prices, said Isfar Munir, an economist at Citigroup. The number of houses approved for construction that are yet to be started surged 5% to 296,000 units. Single-family housing backlog increased 2.1% to 146,000 units, with the completions rate for this segment falling 0.8%. The inventory of single-family housing under construction fell 1.2% to a rate of 816,000 units. So again, it's kind of a mixed bag of news. Some things are doing okay. Other areas are really suffering. Like I said, like I said a moment ago, the housing market is really struggling. I'd say primarily due to the interest rate impact on everything that's going on right now. Because if you could have, if based upon your debt to income ratio, you could purchase a home, a year ago, the numbers have completely changed with that 2% increase in the average mortgage rate over the last year. So it is it's kind of a bind to be in right now. But we had extremely low interest rates for a very, very long time. And unfortunately, this snapback is, the unfortunate consequence of that. So, but, in other aspects, some things are still doing fairly well, even though that the people that they survey don't feel real good about the future. So again, it's tough to fish through all this stuff and make a informed decision. All right, next up, more to do on housing, but internationally. The ticking time bomb, China's real estate bust deepens as housing prices fall for the 11th straight month. If you're worried about the price, of, say, your Floridian beachfront property sliding, be thankful it's not in China. That real estate market, which propelled China's rapid growth ever since the 2008 financial crisis, is in the midst of a housing bust that has now recorded its 11th straight month of price declines. China may be half a world away, but its problems could soon be felt closer to home. Should its real estate malaise spill over into other sectors, it could derail a locomotive that has been pulling the global economy. Major U.S. companies like Tesla, behind it for more than a decade. New home prices in 70 cities, excluding state-subsidized housing, declined in July by just over 0.1% from June, according to China's National Bureau of Statistics. By comparison, the S&P CoreLogic's Case-Shiller U.S. National Home Price Index still managed to eke out a 1% month-over-month gain in May, according to the latest figures available. Industry analysts have warned of a coming correction that would particularly affect overheated markets like Austin. Quote, there's an urgent need for active policies around the country to stimulate a market recovery, end quote. Yan Yuan, research director at Shanghai-based housing market think tank, told state-run publication Global Times on Monday. China has for years preferred that its citizens invest in their own four walls rather than the country's often volatile stock markets in Shanghai and tech hub Shenzhen. Given consumers receive virtually no interest on bank deposits and their money is subject to strict cross-border capital controls, the population has fewer other places to put their growing savings but in the housing market. As a result of a credit-induced boom, Goldman Sachs famously estimated in 2019 that the country's residential real estate market was valued at $52 trillion, twice as big as its counterpart in the United States. Ahead of President Xi Jinping's expected re-election in the fall to an unprecedented third term, however, cracks are fast emerging. Evergrande, the world's most indebted company and China's largest real estate developer, defaulted on its debt last year, while rivals Kaisa Group, Country Gardens, Sunac China, and Shimeo Group are also in various stages of distress. Moreover, many Chinese investors are staging a mortgage boycott, refusing to pay installments on a property that may never be built. According to Bloomberg, the sector has seen at least $90 billion wiped off its stocks and bonds since the year began as a result of the crisis. Making matters worse, President Xi has not deviated from his zero COVID policy, imposing draconian lockdowns that keep the economy from returning to its prior boom. Most recently, the tropical tourist hotspot of Sanya, a kind of Chinese Hawaii, has been affected by an outbreak impacting travel to the popular resort. In a move to alleviate the situation, the country's central bank trimmed two key interest rates in a surprise move on Monday. Whether that helps stimulate demand going forward is another question. On Sunday, Hong Kong daily South China Morning Post, which belongs to Chinese e-commerce giant Alibaba, warned 50 million vacant apartments could flood the market, calling it a, quote, ticking time bomb, end quote. So yeah, it could be much worse. I mean, anyone who's been paying attention to the international finance has been aware of this for quite a while. I had moved a lot of my international holdings out of China last year just because didn't really want to deal with that toxicity. But, they still may have a way to go before they get out of that mess. All right. For those who've been watching regularly, I talk a lot about energy prices, and this has to do with oil. So they're estimating some sort of a bounce back here in the near future. So let's read through this. WTI rises after API shows huge gasoline draw. Speaking on CNBC, Goldman's head of commodity strategy, Jeff Currie, explained why lower price of oil drops, the higher it will jump because all else equal, as demand for oil rises thanks to lower prices without enough supply to match, inventories will shrink far faster and tank bottom will be hit well before the NBER admits a recession has arrived. That's from the National Bureau of Economic Research. A similar development took place in January of 2007, more than a year before the 2008 recession, but not before oil soared to an all-time high. This time won't be any different. And an early glimpse of how the spike in demand will translate into lower inventories came moments ago after the American Petroleum Institute, which reports a draw this week for crude oil of 448,000 barrels, while analysts predicted a far smaller draw of only 117,000 barrels. And here is a breakdown of the different types of oil products. Crude, we just talked about a draw of 448,000. The expected was 117. Gasoline, 4.48 million barrels. The expected was 1.1 million. Distillates, a draw of 759,000, which I think diesel falls into that. And Cushing, I'm not quite sure what Cushing oil is, up 250,000. In the week prior, oil price reminds us that the API reported a surprise build in crude inventories of 2.156 million barrels after analysts had predicted a draw of 400,000. Of course, a big part of the delta is the continued drain of the of the Biden Strategic Midterm Reserve. The latest draw comes as the Department of Energy released another 3.4 million barrels from the Strategic Petroleum Reserves in the week ending August 12th to 461.2 million barrels. U.S. crude inventories have shed some 61 million barrels since the start of 2021, with a 1.7 million barrel gain since the start of 2020, according to API. U.S. crude production data for the week ending August 5th rose 100,000 barrels per day to 12.2 million barrels per day, according to the latest weekly EIA data. WTI was trading down on Tuesday on disappointing economic data out of China and the improving prospects of reaching a nuclear deal with Iran. The API also reported a draw in gasoline inventories this week of 4.48 million barrels for the week ending August 12th, compared to the previous week's 627 barrel draw. Distillate stocks saw a draw of 759,000 barrels for the week, compared to last week's 1.376 million barrel increase. Cushing inventories rose by 250,000 barrels this week. Last week, the API saw a build of 910,000 barrels. Official EIA Cushing inventories for week ending August 5th was 25.189 million barrels, up from 24.466 million barrels the week prior. At 5 p.m., WTI was trading down, with Brent trading down at 92.71. In a few weeks, both will be trading far higher. At least that's his estimate. We'll see. I think there's a lot of moving parts there that complicate the issue as far as demand and how much is being pumped and how fast they can refine it. So we'll see. It's a mess right now, but it's a good thing we've got, the people in Washington taking care of us. So anyways, all right. Well, hope everyone has a fantastic evening. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And hope everyone has a fantastic night. I'll try to calm down and not be so angry at the municipal employees that my taxes pay. Granted, they're all thieves and should be strung up by trees, but that's just my libertarian opinion. All right. Well, hope everyone has a great night, and I'll talk to you soon. Bye-bye.